today I want to kind of like deep dive into kind of what fundraising means and what it is, and give you the full spectrum of fundraising options as entrepreneurs here in the UK. So I'll just start off with a little bit about myself. I'm not going to go into the detailed history of my working history, but when I left Brunel, initially I co-founded a business with my brother and a few friends, which was a music technology business that my brother actually still runs today, called Mixtape Madness. And I went on this journey almost after that as a bit of an entrepreneur, you know, working within corporates, but starting up new business units, working with Ernst & Young across Europe, and then a small management consultancy called Elixir across Africa. And a real pivotal moment along my journey was I was basically seconded to San Francisco for just under a year. And during my time there, I was building a new innovation service for the company where I was connecting a lot of the leading venture capitalists to a lot of corporate clients across Africa and the UK. And that was really almost like a fast track MBA into entrepreneurship and venture capitalism. And I learned a lot there around kind of like, I guess, how the system of funding really works. So I came back to the UK and joined a startup called World First as their first product manager. And then helped them scale their product and UX function across London, Hong Kong, and Shenzhen before they got acquired by Ant Financial. So by this stage of my career, I'd had experience as a founder myself. I'd helped businesses build almost like business units within their business. And I also been at a scale up that has been acquired by a bigger company. So the kind of missing, I guess, string to my bow at the time was the experience of really being an investor and understanding what it means to be on that side of the ecosystem. So in 2018, I joined Backstage Capital, whose investment thesis was really all around investing in underrepresented founders. So women, people of color, and LGBT founders. I helped them raise $2.5 million. And we started an accelerator program in Philadelphia, LA, Detroit, and here in London, where I'm based. And I was the managing director also of that London operation, where we invested in around 25 different startups. Outside of that, I've invested in around 7 startups as an angel investor myself, both tech and non-tech startups. I'm happy to go through the difference between those as well. And today I run the Angel Investing School, which trains professionals on how to invest into the next generation of diverse entrepreneurs. Really proud to say that around 73% of our cohort are people of color, and around 43% are women. And the reason why it's really important, this school, and why it exists, is because actually it's really important to democratize access to the knowledge, capital, and networks that is involved in this ecosystem of entrepreneurship. And today, actually, a narrow set of contributors has meant that actually the majority of funding has traditionally gone to a lot of middle-class white men statistically. So, you know, the goal of the Angel Investing School is actually to really widen participation so that entrepreneurs can truly come from anywhere, and to really empower that first round of funding for diverse entrepreneurs that may not have the friends or family with wealth to contribute to their first round of funding. But we're going to get into all of that detail and more today as I go through the presentation. Okay, so in 2016, actually, I wrote this blog around pre-seed funding made simple, and this presentation is based on this original blog, so I'll be happy to share this original blog post after. And of course, my thinking has evolved since then, so it's probably a little bit embarrassing compared to what I know and going to share today. Okay, so the first thing to really understand is that there's a difference between a startup and a big company or a corporate. Okay, in a startup, the real primary purpose is to join a founding team on this search for a repeatable and scalable business model in order to become a company. So really, you're just a team of researchers. And what you're trying to do is really validate a number of hypotheses, run a number of experiments to find out if you can reach this point. But the journey is really to reach this point of product market fit, where you can really scale the business and sell to more customers like that. And that's where you really enter the phase of becoming an actual corporate or a real scale-up company. A company differs in that a company sells a product or service in exchange for revenue at a profit, right? Another difference is that a company has a lot of historical data on their performance. So they're able to better forecast actually what they're going to do in the future and write business plans based on what they're going to achieve. Whereas a startup actually has a lack of data and actually is a very high risk experiment. And you're going on that journey to really validate your steps and really gain that data to inform actually what you do going forward, which is why we don't really necessarily use business plans all the time when starting a business, but rather use tools such as the business model canvas or the lean canvas to capture your idea really quickly and understand what assumptions you want to go and validate. So this context is really important to understand, because what we're saying is that when you start a business from scratch, you're essentially going on this high risk journey of hoping that that business will turn into a company. And we know that, in the first 3 years of starting a business, over 89% of new businesses fail. So if you're an investor in these new businesses, you're taking a high risk in the hope of getting high reward over the businesses that actually turn out well and grow. So the top 3 takeaways to really understand is that, revenue from customers is the best way to really extend your runway. That's the best form of working capital. Having a product that customers really value and it delights them, and in exchange for that value, they're able to continue using your product and giving you that income that you need to continue to build your product. Okay. The Kaufman Foundation published a report last year that says that as little as 0.5% of entrepreneurs obtain capital from venture capitalists. Actually, about 24% obtain capital from loans and banks, essentially, and alternative providers of loans and debt. So, a lot of the times we see, entrepreneurship and venture capitalists really glamorized in the news, right? They get the lion's share of the attention when we talk about funding rounds and exits and unicorns and Ubers and Airbnbs. But actually, the majority of entrepreneurs don't go on that journey themselves. So it's really important to understand that framing before starting on this journey yourselves. And the third is, it really relates back to that first point. Customer-funded businesses remind founders to keep paying attention to customers' unmet needs, right? To focus on what they can do for their customers rather than their investors. Because in the end of the day, you're really trying to provide value to your customers through solving problems for your customers on a continuous basis. That's what keeps them coming back and keeps them wanting to use your product. So that's where the focus should really be. And in doing that, you should be creating more value for your business and therefore more value for your investors long term. So I'm going to really walk through and at quite a quick pace all of these different options of funding that you face as an early stage entrepreneur. Okay, and then we're going to open up to some Q&A towards the end so that we can get into more detail with the actual questions that are tailored to your specific circumstances. Okay, so as I said before, the most efficient and effective marketing is one of product, right? It's one of happy customers and recommendations. So if you remember the early days of, WhatsApp or Instagram, there were no ads on the internet. There was no billboard ads on the tube. Actually, what happened was that someone within your network told you to join WhatsApp because it's such a great service. And through word of mouth and recommendations, it spread like wildfire as a better alternative to sending SMS text. And that's what great products do. Great products are shareable through word of mouth because they're so much better than the existing alternatives. So I've got an article actually that was published last year on this subject. Most founders think that they need funding when really they need to learn how to build great products that lead to them really building income through the revenue that they're getting from customers. The first option for a lot of entrepreneurs, and sometimes this is default and because they don't have any options, is to bootstrap. And bootstrapping just means really building up some runway based on your savings, right? So you might be working in a job and you save enough money to cover what I call your minimal viable income. So you build enough income savings to cover how much you need to live by for, let's say, 3 to 6 months. And you treat that as your runway. So you say to yourself, actually, my roadmap is that within 3 to 6 months, I'm going to validate whether or not it's worth me pursuing this idea as an entrepreneur. Okay. And that wording I use intentionally because I want you to take the pressure off yourselves. You're a researcher, all right? And you're just trying to research whether it's worth you spending time developing this idea and pursuing it as an entrepreneur. Sometimes we put this pressure on ourselves to become entrepreneurs and to share it on social media, but actually it becomes a bit of a self-fulfilling prophecy because we then feel like we need to live up to that, even if that idea is failing. So try to just separate yourself from that anxiety and from all that pressure and just treat it as if you've got 3 to 6 month runway to really test your ideas. And once that's validated, it will allow you to transition from working, in the evenings and weekends to working full time on your idea. Okay. The second option for some of you, and not all of you, I understand, is the bank of mum and dad, right? So you may actually have family members that, love you so much, they're willing to, invest a little bit of money and put it behind your idea. In the back of their minds, they feel like they've probably lost that money, but they're okay with that because they're backing you, because they love you, because you're their son or their daughter or their family member and their sibling, okay? Bank of mum and dad is what we call like amateur investors. They haven't necessarily got experience in investing. They haven't necessarily got networks of people to connect you to. They haven't even necessarily got the skill set to add value and help you along this journey, but they're willing to back you with some capital to give you that runway so that you can experiment and figure it out and go along this journey yourself, right? And there's different arrangements there. You may, ask to borrow money that you'll pay back in a certain time period, or you may ask for money in exchange for equity into your startups. You're giving them some equity with the hope that over time you'll be able to build a company of value, and that equity will actually be worth something in the future for those early investors that you reward, okay? And these early investors get rewarded in 2 ways, typically, right? Either your business gets acquired by a bigger business, and actually that equity then gets exchanged for an increased value of money, right? So I might invest £20,000 and in 4 years, actually your startup's worth $1 billion, and I could get back, let's say 1.5 million for that initial investment. Another way is that you IPO. So actually initial public offering. And this is where your company floats on a stock exchange like the FTSE 100, let's say, or the S&P 500. And in floating on these stock exchanges, you're essentially selling that private equity to the public. And now the public can participate in purchasing stocks. And by doing that, as an investor, you can exit and again, make a return on the initial capital that you invested into the company. Another avenue is grants and competitions, right? So there's a number of different grants and competitions that are usually industry specific, right? So if I'm working on like a social impact project, I might want to look at the National Lottery Fund or Unlimited or the Prince's Trust. But if I'm working within the sciences, I might look in the Digital Science Catalyst, or in the creative arts, I might look at the Arts Council. So there's a range of different sources for grants and competitions depending on what industries you're in. And Innovate UK is a great source actually for many of the grants that people apply for, as well as Nesta and the Nesta challenges. So there's also government funding. Okay, so this year actually, because of COVID and what we've been going through as a nation, the government's introduced things such as the bounce back loan as a form of government funding to stimulate investment into entrepreneurship and into entrepreneurs, because entrepreneurs can lead to future job creation and obviously future contribution through taxes to the economy. So, every government understands the importance of entrepreneurs and really stimulating the growth of entrepreneurship within your country. And within the UK, we've got something as well called the startup loans, which is really an early form of debt and loans up to, I think, around 10K for entrepreneurs at a very low interest rate, similar to, I guess, like a student loan. Right. So the kind of like pro of having like a loan or government loans and government debt is that, you're paying back interest. You don't have to give away any equity within your company. So actually loans in some ways are cheaper than giving away equity in your company to investors, which are very difficult to claw back. Okay. Another, of course, is like actual bank loans and alternative funding. But a lot of the times these are not suitable for new businesses because they look at your credit history, your trading history. And a lot of these loans can be at very high interest rates, such as 26% APR and over. So, a lot of the times actually this is not suitable for a new entrepreneur, but rather entrepreneurs that have been trading for 2 or 3 years and are looking for this alternative type of funding. And it's not only banks. You have places like Market Invoice that lend according to your invoices, or Clearbank that lend to e-commerce startups and software startups according to their digital marketing spend. So there's a very, very fragmented marketplace for lending depending on what type of debt that you want to borrow. The next is crowdfunding and equity crowdfunding platforms, okay? And the difference is that crowdfunding platforms such as Indiegogo and Kickstarter allow you to list your products that you promise to build in exchange for this crowd that are then able to participate in funding that build. And you give that crowd rewards, right? You might give them a t-shirt, you might give them early access to your product, you might give them a behind the scenes look into building your product as a reward for the capital that they put in. Whereas equity crowdfunding platforms such as Seedrs, Crowdcube and Funderbeam actually allow you to raise capital from the crowd in exchange for equity rather than any other reward. Okay, then you have incubators and accelerators. And these are basically co-working spaces that also invest and take a little bit of equity out of your startup in exchange for that. And they usually provide some sort of curriculum to really like train and support entrepreneurs along those early stages of their journey, right? And some of them have some specialisms too. So you've got EF right at the end, which is Entrepreneur First, which focuses a lot on deep tech. And they invest in talent rather than startups. So you come in as an individual co-founder, they'll help you meet a co-founder, and then they'll invest in certain teams that they believe have promise. Or you have the Startup Discovery School that focus a lot on traction to teams that need help in really doing sales and business development. Then you have angel investors such as myself, who are individuals who have some money and want to put it to work in investing in startups. Usually they invest alone or as part of a group of angels that we call angel syndicates. And these angels often leverage not only their money, but also their skill sets and their networks to really add value and support startup founders in their early stages. Okay, part of the challenge with angels and angel networks is that it's a very fragmented network. It's difficult to find angels and to really understand actually who a good or a bad angel is. But below, I've shared a few different databases where you can research and find angels, such as on Syndicate Room or the UK Business Angels Association's website, or Crunchbase and Angel List, which are and as well as syndicates, such as the Green Angel Syndicate that we have here on the page. And then finally, we have your venture capitalists, right? Your VCs. And basically, venture capitalists raise money, other people's money. So they raise money from private institutions, from family offices, from endowment funds at universities. And they basically use this money to invest in entrepreneurs. And they really try and invest in a high volume of entrepreneurs in the hope that a small number of them will do really, really well, what we call 10x, and grow really, really big to become billion-dollar companies to return the whole fund, right? So, you know, they build a massive portfolio knowing that actually 90% of the entrepreneurs are probably not going to reach the level of ambition that they need, but they're hoping that the 5 to 10% that do make enough of a return to cover the bets that they take. And there's a number of different VC funds here in the UK with different specializations, whether you're a B2B startup or a business to consumer startup or working within specific industries such as healthcare. So it's depending on what type of startup you're building will depend on what type of venture capitalist that you'll approach. And they often do these things called office hours where they invite entrepreneurs in to have conversations with them and provide feedback on their pitches so that you can also build a relationship with these VC investors as well. Okay. And the last thing I'll say before wrapping up actually is that in the UK, angel investment stimulated further by the Treasury Office with something called EIS and SEIS. And they stand for the Enterprise Investment Schemes and Seed Enterprise Investment Schemes. Ignore the text on the slide. What this basically means is that angel investors get a tax relief and a tax benefit when they invest in entrepreneurs, right? So they're rewarded by getting basically money back for investments they're making into entrepreneurs. So if I invest £10,000 into an entrepreneur, I could get 5,000 back basically in tax relief, even though that entrepreneur is receiving the full 10,000 in value. Okay, so that's the EIS and the SEIS scheme. So just now we just did a quick whistle-stop tour into actually all of your different funding options as entrepreneurs here in the UK. They are quite vast, and I know I've gone through quite a lot in quite a quick space of time, but I'm happy now to, I guess, open up to a bit more of a Q&A so we can have more of a conversation about fundraising and what your options are, and maybe some of your personal challenges you're facing on your journey of becoming entrepreneurs for those that have started along that journey.
Great, thank you very much, Andy. That was really insightful. And I particularly myself found it quite interesting what you were saying at the end there about the incentive for investing as an angel. So feel free to put your questions into the chat box. We will try and get as many of them answered. We've got around 20 minutes should we need it. The first question has come in. Chaitana. So the question is, when you raise angel investment, what equity do you give away, and how to value the company at an MVP stage?
Yeah, it's a great question. Typically, with each funding round, you're giving away between, like 10 to 15% in the early stages and 15 to 20% in the later stages of fundraising. And the important thing to understand there is that, regardless if you're at idea stage or at MVP stage, or you have an initial product, kind of the market determines your value, right? There's no value in doing all of these calculations like your discounted cash flow formulas or net present value. The truth is, actually, you're an early stage business with not much data right now. So actually, you need to kind of go through that negotiation with investors to understand actually what the right valuation is for your business, right? And they're often going to benchmark against other businesses that they've invested in at that stage. And you're often going to benchmark through doing research on databases like Crunchbase and speaking to other entrepreneurs to really come up with a valuation that you feel is fair. The key thing is to try and protect your equity as much as possible. Because, once you give that equity away, it's really hard to get it back, right? And you don't want to go through numerous funded rounds to the degree where actually you get disincentivized from running your business. So if we look at a startup that is scaled up and grown like Box, which is the online cloud storage software, Aaron Levine, the actual founder of Box, was left with 3% equity when he was going to IPO Box. So, he's left with just such a small amount of equity. So even though his startup is worth such a lot of money, he's actually not going to see as much from the IPO because he's left with only 3%. And actually, you may not be incentivized to even run the business if you get diluted down to that stage. So you really have to be quite tactical in how much capital you're taking each round and how many rounds of fundraising you want to take to make sure that actually is still worthwhile building your company. And if we look at the Airbnb founders, they're about to IPO now. And actually, they own 45% of their company, even though they've taken on about $6 billion dollars worth of venture capital. So they've done well to really protect their equity up to this stage.
Okay, lovely. Thanks. We've got another question here from Dev, which is, warm introductions do play a key role. How do you crack that if there is an angel you really want to work with but don't have the introduction?
It's a great question. So there's a number of different things you could do. Okay, next. The first is to really empathize with angels and step into their shoes and think, where do angels hang out online and offline, right? So are they part of a certain angel syndicate group? If so, maybe you should attend one of their demo days and participate and try and connect through just being present at that demo day. Are they speaking at a certain event, right? During COVID, so many people have been speaking at virtual events. So could you attend that event and, connect in that way, or cheekily sign up to the event? Maybe you don't attend, but you connect after and acted like you at least attended the event. I wouldn't advise doing that, but it's understandable if you do, and you have to look for those ways in to build a relationship, essentially. But by far, actually, the best introductions that I've got from founders are through other founders. So I love it when a founder introduces me to another founder. So if you can try and make inroads into founders that they've invested in and really understand what they look for in the investments that they made, what do they look for in investing in that founder, it allows you to articulate and position your startup better, but it gives you an authentic way in building a relationship as well. And the key is to try and actually build relationships long before you need to fundraise so that you really understand them. You understand if it's someone you would enjoy working with and partnering with along your journey, rather than treating it as a transaction to just gain the capital and investment, because some angel investors could be a nightmare to manage and some really are armchair investors as well. So it really depends on what you need. So you want to build a relationship before transacting and getting capital from them.
Great, thank you. Dev's put, thanks a lot for your answer. So, and I saw him nodding away there. So a question has come in from Aaron Koshal, who's actually one of our leaders for our new Brunel Entrepreneurial Network. He has asked, can you talk about an any examples of companies that you have personally invested in? And can you give us an example of terms you have agreed on?
Absolutely. Terms are a little bit harder because the term sheet often has a number of different terms in the term sheet, but I can walk through some tricky terms that, on the surface, you'll have no clue what they mean. So this year I invested in a digital marketing agency called Translate Culture that focuses on basically using data to inform your digital marketing strategy. So they're not really a tech company. They're tech enabled to some degree, but actually there's a lot of human capital that's going into that business. And the advantage that founder had is that I've known that founder for 15 years. So I know his strengths, I know his weaknesses, I know where I can add value to his journey, right? And the agreement actually that I made with him as an investor is that he needed someone to take on the role of head of business development and to really basically close those first initial clients and build a pipeline of clients for him to close. And my deal with him was that I'll invest a certain amount of capital. It was around £10,000. And I would also build up 30,000 in, I guess, monthly recurring revenue from clients in the first 12 months. And we've done that. And now he's going to grow to around 50,000 a month. So as you can see, I was very hands-on in the business. I was literally an employee. And I think as an angel investor, you have to have this mentality that you're going to write the check, write it off, and go to work. And you're literally an extension of their team. And the best investors are the ones that are willing to go to work because they feel as if they're a part of the team. They're invested in this too. In terms of the term sheets are like a guide rather than like a legal requirement, legally binding document. Okay, but there are a few terms to really pay attention to, such as the valuation that's quoted within your term sheet. As founders, you have what we call like common stock or ordinary shares, whereas a venture capitalist and a VC investor has a preferred stock. Okay, so angel investors will come in on those ordinary shares, whereas a VC investor will come in as preferred stock. The reason it's important to understand that is because if your company does grow and exits, right, so IPOs or gets acquired, they will get paid out before you do. Okay, and they do that to mitigate their risk because this isn't a loan or a debt. They're putting all of their money at risk, and if you don't do well, you don't do well. They've lost their money. So they see it as if you do well, they need to get paid out first before you do, right? So it's important to understand the incentive structure of a VC and how they work and why they work in that way. And the other one is more for investors, is around, what we call like a dragon tag, right? Really stupid colonial language here, but a dragon tag is basically when you have an option to exit your startup. And as a lead investor, I can say that I want to drag the other investors into this round. So because I'm a lead investor, I want to make sure that the other investors need to tag along and exit with this too. Like we need to agree to this exit. And the reason that it can be a political term is because if you think about it, for an angel investor and for, let's say, a founder like myself who came from a working class background, I might have an opportunity to sell my business for £30 million. For me as a founder, that's life-changing money coming from where I come from in life. To you as an angel investor, that's a great return because you invested so early. But to a VC investor, that's a terrible return. And for them, they want you to exit at a 1 billion plus because they've invested later in the game. So actually you returning to them, maybe 2x multiple or 3x isn't good enough. They want a 10x plus multiple to pay for their portfolio. So they're going to be in your ear telling you to carry on going and that you're more ambitious, that actually there's more runway here and you should continue to build your business. While your angel investor might be saying, actually, this is quite a sensible exit. I understand it's not, a $1 billion exit, but like, I will do well out of this. And so will you. This is life-changing money. You could use this money to then start another business or do whatever you want or, pay for your mom's house. Like, and both are right, but it depends on you and what you want to do and what your aspirations are, right? And that's where you need to understand like how these terms protect the founder or protect the investor.
Yeah. That's so interesting to you speak. I'd be actually interested, there are other questions in the box, but to hear whether you've invested in something that hasn't gone, that you might see, I don't know whether you'd call it a failure, but something that just hasn't gone the way you'd hoped.
Yeah, let's talk about this word failure for a second, actually, because I think, do you know during my time in San Francisco and Silicon Valley, like there was definitely a badge of honor around failing. But honestly, for me, growing up, failure was a bad thing. Like I grew up in an environment where if I lost a football match, I felt bad. Like I didn't enjoy losing. So I don't enjoy failure in the same way, but I do value the concept of learning, right? And continuous learning and fast learning. So I don't believe in failing fast. I believe in learning fast. Like when you're experimenting and you have a hypothesis, you're not incentivized regardless if you prove or disprove that hypothesis. Both can help you. Like if I disprove that hypothesis, I might have saved money, time, and effort in building something that nobody wants. That's a great outcome. If I prove that hypothesis, great, I can take a step in the next direction and continuing on with that idea. So both are good options. Okay. So back to your question around, what was your question about again? Sorry, it wasn't about failure.
Well, just wondering, because you talked about an example that you gave of something that it clearly went very well. And as I imagine you've done this quite a bit, have there been some that have really not gone so well? Or
Absolutely. My first investment was into a technology startup that focused on maintenance work for engineering, civil engineering materials in Africa. Okay, so they had procurement contracts with big like mining companies and drilling companies around maintaining a lot of their infrastructure and the upkeep of the machines that they used to do their works. And I was too passionate and in love with this story of, wow, like it's on the continent that I love, Africa. I originate from Ghana, and it's a startup, and I believe in the founder, and I love what they're trying to do and their aspirations here. And I got too in love with that idea I had in my head, and I didn't do really good due diligence. And what happened in the end was that they had a lot of procurement risk with their contracts, and the payment terms were too aggressive. So they would complete work in, let's say, 26 days, but they wouldn't get paid for 90 days. So then they couldn't then reinvest into the materials and paying for their operating costs in order to sustain the business to fulfill the contracts because the payment terms were too long. I didn't understand that because I'd never experienced it before and I was new to the world of investing. So I got caught out as an investor, but through doing that, I learned now certain things to look for in due diligence and actually what I will and won't invest in. So I don't invest in anything I don't understand. So I'm fascinated by blockchain, but I don't really understand it deeply. So I don't understand the value it can really create long-term. So I won't invest in that area, and that's okay. Right. And then there's certain domains where I'm more willing to invest in because I've worked in it, such as fintech, which I understand deeply, or pharmaceutical sector, which I work in deeply as well. So I think it just teaches you over time to understand your boundaries and and tighten in your investment strategy as you go through these experiences. But as an investor, I'm no fool to the game, and I understand that as I build a portfolio, a lot of those startups are not gonna sadly return money to me. So I'm not in it from a capitalistic perspective for the return. I'm really in it because I get the privilege of going on this life learning journey with technologists that are teaching me about groundbreaking technology and how they're solving problems in the world that fascinate me. So, I go on that journey because of that. And I know that if the worst case scenario is that I can go along that journey, add value and learn from it too, I'm okay with that. I'm at peace. I'm peaceful with that.
Yeah, absolutely. Never a failure. Always a learning experience, I say. There was a question from Mac, which is, would you recommend a new startup now in the area of predictions, given that football fans are not allowed to visit the stadium currently?
So, I talk about this concept of strong swimmers with strong tides. Okay, so a strong swimmer is a founder who clearly has a background that is well suited to doing what they're doing. So, if you've shown me that actually you've done like a PhD in predictive analytics, or you'd worked for Opta or 2 or 3 companies in this area, then I think, you look like you could be a strong swimmer, when it comes to this idea. But then strong tides talk about the trends that you foresee in the next 5 to 10 years. And a big part of being a VC investor is about trend analysis and what trends do you really believe in that you're investing in and betting in, right? So 2 years ago, certain VCs really believed in remote working and, remote video conferencing, and they invested in startups like Zoom and Hopin. Today, these startups are worth a lot of value because of COVID, which has accelerated that trend, right? So my question back would be, do you believe that you're a strong swimmer in a strong tide? And is that a trend that you believe is going to strongly continue in terms of the value of predictive analytics going forward in the future? I've not thought deeply about it. So it's not a trend that I yet believe in because I've not done the research. But if it's a trend that you believe in and you believe is a trend there and there's something there, then you should absolutely go for it.
Thank you, Andy. So I'm going to tie the next two questions together. Karen has asked, how do you decide which type of funding would be best for your business? And then there's a question immediately after, for a digital membership services in the automotive industry, what type of investment would you suggest would be best? So thinking about it generally, how does one decide what's the best form of investment?
Absolutely. As I mentioned before, the customer funding route is the best form of investment, right? You want to show that you're delivering value to the market and that the customers appreciate it because you're delighting them and they're paying you for that service. That's the best form of funding, period, right? With certain ideas, it's actually hard to get to a stage where you have customers, such as deep tech, right? When you're creating a deep tech idea, actually there's a lot of money that goes into research and development. So you need to kind of like secure that capital first. And with certain hardware ideas, it's the same is true. So the two variables to really understand is what type of business am I starting and what stage is that business? Okay. So as I said, like if I was starting an e-commerce business on Shopify and selling, I don't know, socks, happy socks across the world, right? Angel investment and venture capitalism isn't probably the right route for me, because these aren't the type of businesses that typically grow to billion-dollar businesses, number one. And number two, actually, like given the type of businesses they are, I shouldn't have to actually give away all of that equity to build this business. I can actually start getting that engine going in a really small way to sell a few socks to a few customers to get a little bit of revenue in and then start growing it in that way before taking on, for example, a loan from Clearbank, who lend against your digital marketing spend. Right. So it's very well suited to e-commerce company, because e-commerce, a lot of that is really about understanding your customer acquisition cost and your lifetime value, and actually putting your money into paid advertising to bring that return in terms of customers that come in and start purchasing your products. So understanding what type of business you are really dictates the kind of route that you go down. The one caveat I would say for people that want to go down the angel and VC route is that you have to believe that you're building a category winning company. Okay. And what I mean by this is that you're ambitious to the degree where you believe globally that I'm going to be the number one company at X, right? So with Airbnb, they believe they're going to be the existing alternative to travel and accommodation. With Uber, they're going to be the existing mode of transport across the world. All right. And if we look at Uber as an example, they've got a competitor called Lyft in the US and in Canada. Lyft are not globally ambitious. Lyft have not scaled across the world. So Uber have won that category against Lyft because of that ambition, or that lack of ambition, depending on how you see it. Okay, so if you're not prepared to build a globally important company, then maybe you shouldn't take on that funding, because it comes with a lot of pressure to build a company in that way. And if you try and build a company in that way with that pressure and you fail, you may argue that, I wish I never took that funding because it impacted my strategy and I was growing at all costs and actually it cost me my business. And that happens a lot of the time with these businesses, because there's a life cycle in which, in a time frame in which they have to make a return for their investors, because you took on that money. So you're taking on that obligation that I'm going to grow at a certain speed within a certain time frame. So I really wouldn't take on funding until I really understood what type of business I was and what stage that business is at.
Okay, thank you. Okay, we've got 3 more questions. We're going to see if we can move through them before we finish. So one from Megan is, what if you have a specific niche with no businesses occupying the market? How would you recommend to calculate the value?
There's 2 things there. Okay, so when you have a niche where you believe there's no existing competitors, there still existing alternatives. Okay, and an existing alternatives is basically what are people choosing to do today to get that job done, to solve that problem. And that is your existing alternative. So for example, I run the Angel Investing School. In the UK, there was no other company running a school teaching angel investment. No university as far as I'm aware of either. But if people wanted to learn about angel investing, there's all of these different existing alternatives, like watching YouTube videos and listening to podcasts and reading this book, or traveling to San Francisco and taking this course by Jason Calacanis. So there's all of these or speaking to angel investors and having coffee catch-ups with angel investors and figuring it out that way. So there's all these existing alternatives that exist for any idea, right? Regardless if there's not actually another company that's competing with you. The second thing around like identifying your value is, as I said before, the market is the market. And ultimately the market will determine your value for you. So as soon as you start really, having those conversations with investors, they're going to peg you against a certain benchmark. And you're going to have to negotiate based on what you truly believe the value is for that company. If you're clueless, then you're kind of subject to being influenced by what they believe. But actually, if you have some idea of what you believe is fair value, then you can peg it against something. As soon as you start making revenue and start making a profit, ideally, then you can start really pegging against your industry and understanding what the multiples are within your industry. So if I'm a digital agency, the multiple is usually 3 times your EBITDA, so 3 times your earnings before interest and tax. Whereas if I'm a software company, is usually, let's say, 4 times my revenue. So I know that actually I can value based on that. So that's how over time it becomes easier to put a valuation around your company. But you can't get too caught up in the early days because it's basically such a high-risk company with so many assumptions to validate that even the valuation in itself is an assumption. And an example of how your valuation gets determined for you is that if you entered into an accelerator or an incubator, they're going to invest at a certain rate, right? So when I was at Backstage, we invested $100,000 for 5% of your company. So that put you at a pre-money valuation of $2 million automatically because we just invested $100,000 for 5%. So 100% of your company is $2 million. So then again, the market is the market and the market has determined your value, right? And it's not necessarily the right way or the best way, but it's the market. It's how we do it today.
Great, thank you. So a question's come in from Bob. So he's a 25-year alumnus. Can you advise an appropriate position on the funding scale for him to start a second career after 25 years of manufacturing as a human resources and training manager?
So is this question more around career advice and what you want to do next in your career, or is it the fact that actually you believe that you want to start a business now? If it's like around starting a business now, then I'd be fascinated to know, like during your 25-year career, what problems and inefficiencies have you noticed in manufacturing when you're working that you feel like need to be alleviated and solved for, and you feel like the existing people that are trying to solve that problem aren't doing it in a great way? And that's where you start. You start with a personal pain point, with that itch that you just have to scratch. And actually, that's where it comes from, because then it comes from a truly pure place that you understand and you have deep knowledge over. And you probably have a good network too, because you've worked in the industry for so long. So you know the kind of people that you would hire. You know the kind of publications that you would want to get PR in, right? You know where your customers exist online and offline. So actually, you know more than you probably think you do, right? When it comes to starting a business in that area. So I think you start with the pain point and the problem to really think, actually, where is there really an unmet need and a problem to solve based on the personal experience that you've had in that industry?
Absolutely. Interesting answer. Yeah. Okay. Our last one, we've got one more after this. We might have to get in quickly. Is from Shetiana. I really apologise for probably not pronouncing your name right there. And the question is, what are your thoughts about convertible debentures? Is this something a startup should consider to raise funding?
So convertible loans take form in very different, there's a lot of different products right now in the market for convertible loans, okay, such as the Safe Note that was created by Y Combinator, which is an accelerator in the US, or just a typical convertible loan. In all of its flavors, all it really is saying is that I'm going to give you, you're going to invest in my startup, and it's going to be a debt initially in a loan, and it's going to convert into equity priced at my next funding round. Okay, 95% of investors that I've met have never tried to act on the loan. They've never tried to get interest back off the loan. So during that, there's usually a time period and a cap. So after 36 months, then there's interest charge on the loan. And really what happens is that the founder really fundraises within that time frame, or shows intention to fundraise and gets that cap extended so that it doesn't turn into any interest-bearing loan. And then actually what the investor really wants is equity in exchange for their money, not the loan. So it's really one of these kind of like, I don't know how to say it, like, is a tool that's used to mask the fact that we're still just in like trading equity for money. It's not really a loan or a debt. So it's dressed up like it is a loan, but honestly, no one that I've ever met has tried to get interest off the loan, because it's such a high risk startup. It's like the startup can't even afford to pay you that money back of interest anyway. You know the risk that you're taking on.
Last question. So following on from Megan's question, I believe. So this question's come from Asma. Following on from that question, with huge alternatives such as eBay, could starting up a niche e-commerce business be successful?
Oh, absolutely. We see it every day. There's a sea of niches that you're not aware of, right? So I told you my brothers and I started a music business about 2 years before iTunes and Spotify. On paper, oh my gosh, like look at those competitors, you're not going to make money. My brother makes like that, the business generates over $1 million every year, right? So there's a sea of niches that can make good money. It just depends on your aspiration and how big you want to grow it, right? Like there's certain marketplaces online just for cars and automobiles, like even Auto Trader, right? Arguably, Auto Trader is taking just one segment out of eBay, but it's built a massive business off the back of it. So absolutely, you can make money from a niche, because I think the internet, the thing that's unique about the internet is that it connects a long tail of consumers in a way that's never been done before, right? So we are able to reach people in the Philippines, in China, in Brazil, over the internet with products that we serve. And we couldn't do that pre-internet in the same way. And I think that's where niches are never really truly just a closed niche.